The fate of the housing market in 2023 is heavily dependent on what happens with mortgage rates this year. In today's video, I'm going to present my mortgage rate forecast for 2023, which is based on current trends for inflation and Federal Reserve monetary policy. Let's get into it. If you're new to the channel, my name is Eric and I am a professional private sector economist in addition to being a licensed real estate agent in the state of California. So you get a unique perspective on this channel that you will be hard pressed to find on YouTube or other platforms. In this video, I'm going to give you my forecast up front, but if you want to see how I put it together, make sure to stick around to the end of the video. And if you like what you see, don't forget to give this video a thumbs up and subscribe to support the channel. I do need to drop my usual disclaimer around these kinds of projections that nothing in this video is investment or financial advice. I am not your investment or financial advisor, and you are responsible for your own investment and financial decisions. Okay, so right now I'm calling for the average 30-year fixed rate mortgage to reach 7.7% by May 2023 based on where it looks like the Fed is heading with their interest rate hikes. The Fed is likely to hold interest rates relatively steady for a while as inflation continues to trend lower, so I don't expect mortgage rates to move around much from the May peak at that point. I see the Fed starting to lower interest rates in October 2023, at which point we can expect mortgage rates to start to come down as well. It's important to keep in mind that this assumes the best case scenario in that all goes according to how the Federal Reserve is planning it to, which is that they achieve the infamous soft landing where they can raise interest rates just enough to bring inflation down without causing a complete economic meltdown in which they would have to rapidly pivot and start lowering rates earlier. You can let me know in the comment section below how likely you see that happening. If you're interested in how I'm tracking the U.S. economy and if a recession is on the way, check out my other channel, PapayaCast, where I focus on forward-looking economic analysis and forecasts for the U.S. economy. I just released a recession outlook and GDP forecast video there recently, so make sure to subscribe to that channel as well if you want to stay up to date on whether or not a recession is on the way. I'm going to get into my underlying assumptions for my mortgage rate forecast now, so if you just came for the high-level overview and will be leaving now, don't forget to subscribe. If you haven't already, hit that notification bell down below so you know right away when my next video on forward-looking real estate analysis comes out. The first consideration for this forecast is an assumption of what the Federal Reserve is going to do. There are two parts to this. First, what will peak interest rates look like? And second, when will the Fed reverse course and start lowering rates? For the first part, I'm using the dot plot, which is the summary of projections from individual members of the open market committee that sets the Fed funds rate. And I also take public statements from Fed officials into consideration as well. According to the dot plot, the median projection for the Fed funds rate is 5.1% for 2023. As of the recording of this video in January, the Fed funds rate has a target range of 4.25% to 4.5%. So I'm going to assume the Fed raises by 25 basis points at each of their next three meetings, putting the target range at 5% to 5.25% by May 2023, which would include their median projection of 5.1% within that range. And then they will stay there to make sure inflation is on its way down. The next part is to assess when they will start lowering rates. For this part, I'm going to look at the rate of inflation and its relationship with the Fed funds rate historically. In the past, the Fed funds rate has generally been higher than the rate of inflation in its historic trend. The rate of inflation as measured by the CPI was 6.5% as of December 2022, so it is currently well above the current Fed funds rate of 4.5%. There are several signs that inflation has already peaked, and for this forecast, I'm going to assume it has peaked and will continue to decline. So far, CPI-based inflation has fallen by an average 0.43 percentage points each month. If we assume it continues to fall at this rate, it will reach the Fed's 2% target by November 2023. The next question is, at what point will the Fed start to lower rates given this projected trend in inflation? For that, I turn to the average ratio between the Fed funds rate and CPI inflation. Looking back at the last time the Fed had to fight serious inflation in the 80s, the Fed funds rate was an average of 2.2 times higher than the rate of inflation during this decade. This is what the Fed had to do in the past to keep inflation lower after a big spike, and this might be what they will need to do now in their current fight. Now, obviously, no one knows at what point the Fed will feel confident enough with declining inflation that they can start to lower rates. Not even the Fed officials know that. They're still trying to figure it out. But I think that looking back at the historical relationship can definitely give us a good guideline until the Fed reveals more about their intentions. So I'm assuming that once the Fed funds rate is at least 2.2 times the rate of CPI inflation, which will be in October 2023 based on the current rate of decline in inflation and a Fed funds rate of 5.25%, then the Fed will start lowering rates and stay close to this ratio until inflation reaches their 2% target. So we're looking at a Fed funds rate of 5.25% for most of 2023, with rates starting to come down towards the end of the year, and likely it will be 25 basis point decreases at each meeting if the Fed is serious about not dropping rates too soon and giving inflation a chance to pick back up again. Based on historical correlations between the Fed funds rate, the bond market, and mortgage rates, I'm currently looking at mortgage rates to reach 7.7% by May 2023 as the Fed funds rate peaks. Much like the Fed fund rate will be staying relatively constant after that, I see mortgage rates staying in that neighborhood until October 2023 when the Fed starts lowering the Fed funds rate. So we're essentially looking at interest rates to be between 7 and 8% for most of 2023. Keep in mind that this assumes all goes according to the Fed's plan, that they can raise rates just a bit more and hold them there as inflation maintains an orderly downtrend to their 2% target. Now, there are a lot of things that could happen that would change the trajectory, but the biggest one is if there's a severe recession that would cause the Fed to pivot ahead of schedule to stimulate a failing economy. If you want to stay up to date on the future direction of the U.S. economy, don't forget to check out my other channel, Papaya Cast, where I focus on forward-looking economic analysis and whether or not a recession is on the way. Another big factor that could affect this mortgage rate forecast would be a change in trend for inflation. If inflation doesn't keep heading lower, the Fed might raise rates even higher than 5.25% to bring it down. This would likely then lead to higher peak mortgage rates. I'll keep you up to date on any big changes in inflation trends on this channel, so if you haven't already, make sure you're subscribed and hit that notification bell down below so you know right away when my next video comes out. And if you've enjoyed this video, please give it a thumbs up to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.